All right, everyone. Kristen Schiller here in studio. We are officially off to the races for trade on this Friday, rounding out what is set to be a positive week. And in fact, for the Dow and the S&P, the sixth straight week of gains, its longest weekly winning streak this year. Joining me now to break down what it means for you and your money is Michael Lee. He's the founder of Michael Lee Strategy. Michael, great to have you joining remotely. And as we open for trade and look to round out this week, where do we stand for investors?
Yeah, look, I'm very bullish. I think there's a lot of momentum behind this market. I think when the market started taking off a few weeks ago, a lot of hedge funds were underpositioned. This has been a very good year for the markets, close to 50 all-time highs, and so I think there was some positioning, or prior to this last kind of 6 week rally that was a lot more neutral versus bullish. And so you have a little bit of FOMO and some catching up here, and boom, we are off to the races.
I'm curious, Mike, in terms of the outperformance that you see, we've seen market breadth expanding beyond just some of these high-flying technology names. Where are the sectors that might be able to catch up?
Financials is really doing spectacularly. You have like the big banks, you have the big investment banks, Morgan Stanley, Goldman Sachs hitting absolute all-time new highs. You have the XLF, the technology sector, banging on the door of that. If you look at the regional bank ETF, the KB, I'm blanking on the ticker off the top of my head, but regional banks look spectacular from a technical standpoint. And what I think is going on, and with a lot of this market rally and what you're seeing with financials, is the Fed. And I think there's still quite a bit of stress in the banking market from this rate hiking cycle that we have just gone through. And now it looks like we're on the other side of. But when you look at where the 30-year mortgage is, relative, like a jumbo mortgage, relative to where the 10-year Treasury is, you're at almost a 3% spread. Historically, that spread has been 175 basis points. So that extra 125 basis points, to me, signifies a lack of shelf space or inventory or balance sheet for these financial institutions to lend money and to bring down more mortgages and sit on their balance sheet. And I think when you look at the Fed cutting 50 basis points, you need to look at that specific trait, that relationship between the 30-year mortgage and the 10-year Treasury, because if the Fed cuts 50, 100, 200 basis points, even though inflation might not be at the target, the employment situation doesn't really dissipate much further, and it doesn't seem like they have reasons to. If you can get that long end of the curve back sub 4%, a lot of these long-term bonds that these banks own on their balance sheet that were trading in the 50s, 60s, and 70s will go back to the 70s, 80s, and 90s, freeing up a lot more capital. And so when the banks hold these bonds, they are in their held to maturity portfolio, so they do not realize the losses. However, that affects their collateral. So if something's only worth 65 cents on the dollar, you could probably only get 55 cents of collateral, where if it's worth 80 or 90, you can get a lot more, and it's going to free up a lot more of the log jam that's in the banking environment right now. And with inflation, maybe if you err on the high side and it's close to 3%, I don't know that we need a 5% front end to curb that the way that we did a couple of years ago. So when you have an expanding economy, expanding liquidity, growing earnings, the whole market starts to do well. And I think the story of the last few months has just been this expanding breadth.
Yeah. So the question that I have then next, Michael, is what does this mean for deal activity, IPOs, M&A as we head into 2025?
Yes, so I think this has a lot, like the deal activity slowing down is everybody's looking for an excuse not to do something. And so the excuse right now is the election, and that's going to get resolved one way or another. If you look at the betting markets, historical trends and polls, where the polls have overstated the Democrat candidate by 4 to 6% over the last couple election cycles, and where the Real Clear Politics average where it is now, it's in the poly market and Kashi and kind of the other things that are out there, plus the Republican basket traded by Goldman and by UBS hitting all-time highs, that it looks like the market's thinking that a Trump presidency is going to come in. If that were to happen, I think you're going to see a ton of deal activity next year. I don't necessarily know if a Trump loss will stunt that deal activity, but I feel like the election is the impediment to a lot of deals being announced. And so that is going to resolve itself one way or the other in the next couple months. And so that's a very bullish sentiment behind that. But for those uncertain about the economy, uncertain about the election, uncertain about the world, to me, the safest trade is this AI trade, which is a once in a generation technology transformation that is going to happen no matter what happens elsewhere in the world.
Michael Lee, great to get your take. Thank you for joining us here on this Friday morning on NYSE TV Live.